if we look back to 2010 and then forward to 2030, what inning are we in and why, in a sense of the evolution of fintech?
Yeah, I'm happy to throw out some kind of unjustified thoughts. Yeah, I've always thought this was like a harder question because I think it varies. I think my guess is all of us have seen this. You know, fintech is a pretty broad brush to paint with, and there's certain categories, say payments, that have actually been venture funded for like 20 years now. So I'd say in some categories, like payments, we're probably in kind of second, maybe third of kind of many innings. But there's other categories, you know, healthcare payments, B2B payments, where I feel like we're like in the early part of the first inning. I'd say kind of anecdotally though, as a fintech venture investor, I feel like we're in like the second or third inning. And the reason I say this is I remember when I first started, which was just like 4 or 5 years ago, most of the entrepreneurs that I was meeting were former WorldPay executives that had decided that they were going to build something really interesting. And I feel like a really big difference I'm noticing is I'm now talking to Affirm, you know, alumni and Stripe alumni and Robinhood alumni that are kind of building kind of next generation, kind of highly targeted, specific financial technology solutions that we just didn't even know to think about building 4 or 5 years ago. So in that regard, it feels like we're on the second generation of something, but categorically on like a vertical by vertical basis, still super early.
Yeah, I wouldn't disagree with any of that. I think the way I sort of think about it is, you know, PayPal was top of the first, right? And I think that there were a couple other companies that kind of came out of that kind of early 2000s to 2010 era, which I'd call the first inning. Inning 2, maybe into inning 3 is probably the 2010s, right? And we've obviously some iconic companies being built during that time. You think of the Stripes of the world, the Plaids, you know, the firms, the Afterpays, and so on and so forth. So, you know, 2010s was a great time for fintech. I think there was just a wealth of companies created, and I think you know, we're some were in fintech 3.0, which is probably the third inning, and it's going to be very exciting to see what happens.
Yeah, so I definitely don't disagree with anything that either of you guys have said. I guess I'll try to, you know, reject the premise of the question. I think that innings, since baseball is a 9-inning game, like it's hard to frame it when we're currently living in it. Like we'll know, you know, in 50 years from now what 2021 was in terms of the innings for fintech. But I think if we frame it more as a TV show, so I think that we're firmly around season 3, season 4. The first 2 seasons were pretty solid. The third season was incredible, was excellent. And everyone's super pumped about what's coming next. It's definitely going to be syndicated. It's going to be on networks for a long time. And probably, you know, Netflix will pick it up in about 10 years from now too. So I think that everyone's on board. Everyone's going to be talking about it at the water cooler. And that's where we are in fintech right now. But we'll see how it goes in the future.
Interesting. Yeah, I mean, I would also reject the premise that it's more like a TV series, because that can get canceled for someone, you know, speaking against wokeness. And I don't think fintech is going to suffer from the same fate, but I do appreciate you challenging the premise. So let's talk a little bit about, you know, the last year, and COVID has accelerated digitization for many industries. You know, in your view, how has COVID impacted the opportunity in fintech, and specifically for startups looking to exploit inefficiencies or create new categories?
Well, I think everybody would agree that it just created a whole bunch of new opportunity, right? I think there was some hesitancy if we think about what the world looked like a year from now, right? There was a lot of, not just in fintech, but in tech startup world in general, there was a lot of uncertainty. And obviously there's been some real winners, right? There's been some companies that have struggled, but there's also been a lot of real winners. And you could kind of talk about a lot of different areas. I'll just pick on one, and I'll let others talk about other areas. But if we just think about e-commerce for a moment here, right? Let's talk about the merchant base there. I think if you look at everything around serving e-commerce, whether it's the payment side, whether it's the lending side, you know, all of that, you know, has, just as we've watched and everyone's seen that chart, right? As 10 years has happened in 6 months, there's been a whole bunch of opportunity. And the really interesting thing about it, I think, is that all of a sudden you kind of see categories that were kind of thought of as like the sort of dog categories, right? Like lending, for example, right? That was considered a gone category. Nobody wanted to be in it. Like, everybody knows the story of Lending Club and On Deck and Can Capital. And we definitely saw the further sort of deterioration of some of those business models. But out of that, we also saw the birth and acceleration of some quote unquote lending businesses that are now doing really well, right? I'm talking about Affirm. I'm talking about, about Afterpay, about Klarna. These are quote unquote lending businesses. I think they look a little bit more like payments businesses, but because of the underlying merchant base, which is an e-commerce merchant base, they've been able to do really well with relatively low loss ratios and a lot of the success. So, there's a lot of interesting stories where categories like that or business models like that were traditionally thought of as sort of broken were actually proven to be successful just with a different underlying base. So that's been really cool.
Yeah, definitely agree with Alan in terms of the e-commerce aspect. I'll take sort of also maybe a little bit of a different approach in answering just to give a different perspective. And that's that I think with the tremendous influx of capital from VCs into fintech over COVID, and that wasn't obviously unique to fintech. It pretty much happened after Sequoia sent out their post about it seemed like the good times were coming to an end again, and then a month later we were back to the most bull market that we've seen in the last decade. There was just a tremendous amount of capital that was flooding into the early stage, and what I've seen locally is that founders who maybe previously wouldn't have considered starting a company right away pretty much just saw the amount of capital that was there at the seed stage and were emboldened to go out and start companies. And I think as Alan or maybe Vivek mentioned earlier, we're really starting to see the second or maybe even third generation of founders who were trained and were brought up in these large companies that have been built in fintech. And now sort of it's been the marriage of great timing opportunity in terms of capital availability and tailwinds from COVID, paired with also the experience that they've actually been through to go out and start their own companies.
Yeah, I think, like Alan mentioned and Jonathan did as well, I think, e-commerce has done super well. I think one of the things that we've been a little bit mindful of is that venture is like a virtuous echo chamber, right? And certainly it is better for venture capitalists if like digital adoption is better. And so I think we've been trying to be really objective about which categories life is actually easier in and which categories we just want life to be easier in for an early stage startup. And I think the example I'd give or kind of the framework that we've been applying is that COVID gave certain technologies a chance, right? If you think about in healthcare, like telemedicine got a chance. In restaurants, QR code based kind of pay at table got a chance. And I think the way we've been kind of internalizing it is how good is the technology, and given the opportunity, will it create a valuable enough customer or user experience such that you cannot put it back in the bag, right? And I think there are certain places that have definitively been successful. I think pay at table is actually a really good experience at most restaurants, and I don't think it's going away, certainly in the United States. But I think there are other categories where the experience has been really bad. And we're trying really hard to index against those and make sure we're not getting overexcited, because a lot of those look really darn good, particularly in enterprise SaaS, right? We're seeing some of the craziest fundings in the earliest stages of financial services under the premise of like, oh, COVID is making this easier, but we just invested in a pre-revenue, pre-product company. How would we know? Right? we actually don't know whether it's easier or harder. So I think we're taking a slightly more kind of like balanced view, but there's certain categories I think, even in our portfolio, we've seen the shift to e-commerce is undeniable. And there's like a slew of infrastructure providers, both on the retail side and the financial services side, that have benefited from that. And that's not going anywhere. But I think in the more kind of enterprise SaaS categories selling into, hospitals and banks, I think the verdict is maybe still a little bit out about how serious folks are about digitizing when you leave the kind of best or like the largest companies in those categories.
Great, thank you. One, I guess, theme also of like the last year is sort of the consumer fintech neobanks have really crushed it and acquired a lot of new customers and users. What is your take on just the neobank trend or the challenger bank trend in general, also in the long term? And do you do you think we'll see a $100 billion neobank at some point? And if so, when?
And I'm like, as I think most of the folks on this call probably have heard me like bash my head against a brick wall when it comes to like neobanks in the past. And I think in some ways, I think I've definitively been wrong. In other ways, I'm still holding on hope as I am to my GameStop stock. But I think
you're hodling on hope.
Always.
Okay, don't Scott Galloway V2, is that what you're saying?
I think that the thought has always been, or the thought I've always had is that kind of the folks that you can acquire, you don't really want. The folks you can acquire for reasonable amounts of money, don't have the type of financial services needs that enable you to push products that are higher margin that end up making the math work. What I had not taken into account back when I first came across neobanks is that money would be free. And it turns out that in a world where you can, in a no interest rate world, you can raise $500, $600 million and build amazing companies. And what I'd say is that, like, my skepticism aside, I was listening to Ryan King at Chime talk about how when they realized that in the United States, the PPP loans were going to be delayed, they actually off their own balance sheet effectively like factored that payment to their end users, which is like, I think should be celebrated, right? Like, I think say what you will about like business models and capital needs and stuff like that. I think a lot of these neobanks have proven that they can fundamentally improve the value proposition and become a critical part of end consumers' lives. I think that same talk he was talking about, the average Chime consumer reaches out to Chime proactively something like 3 times a month. Yeah, that's a ridiculous engagement and a ridiculous like high trust, high fidelity engagement with a company that did not exist 7 years ago, or in a category where people thought like you would always, respect and treat B of A, even though they charge you an arm and leg. And I think that deserves to be celebrated. I have no idea like what gets valued at $100 billion anymore. Like, who knows? Well, maybe Jonathan and I will see a seed that's doing like $100 billion de novo bank. And I honestly, I wouldn't be shocked. New bank's already a quarter of the way there. But I do think that there's an old adage, right? Never bet against amazing product. And I think that a couple of the banks have proven that they can make like undeniably amazing product experiences, and going back isn't an option. So valuations are confusing, but I do think a couple of these guys are here to stay because they now have access to unlimited capital.
Mm-hmm. Yeah, I mean, I would agree pretty much with everything you just said, Vivek. I would like to say again that I don't know how much of a benchmark $100 billion market cap should be. Like, I think there's only 10 to 15 global banks that are valued that high. And these are financial institutions that have been around, for hundreds of years. So I'm not sure necessarily how realistic that is, but that said, we're talking 10 years, 15, 20 years down the line, then potentially. And again, all it takes is for Chime, Revolut to become a meme stock like Tesla, and they're valued at $100 billion, even though their total assets under management maybe don't really translate to that. But I would say, like, at least from my perspective over the last couple of years looking at opportunities, and I don't necessarily think this is anything new, but I'm much more excited about vertical banks specifically because of what Vivek mentioned in terms of, in theory, the customers that you can acquire as a challenger bank are not necessarily the most lucrative or the type of customers that you want. Whereas when it comes to vertical banks, if you can find a real niche or a real audience that is underserved, or that at least has very specific needs, and you can build a unique offering and a unique product around those set of needs, I think that's a real opportunity. Do I think it can be a $100 billion opportunity? Not sure, but it can definitely be a venture scale business.
Mm-hmm.
Yeah, so I think that there are 2 ways that I think about how to answer that question. One is, if you think about it, we already have one that's over 100, right? And it's kind of wrapped up. I'm talking about Cash App. It's already sort of, it's wrapped up within the larger Square, but it is the fastest growing part of Square. And if you think about where it was from not existing 3 years ago or whatever it was, 4 years ago, to where it is today, I mean, that's a seriously, scaled business. Yeah. So I don't know if you consider that a challenger bank or not, but that is there. And then the second way to think about it is, I think there were a lot of skeptics about this whole, challenger bank space in, call it 2015 to 2018 era, when a lot of them were raising money. But the truth is, the market leaders, and we see this obviously across all sorts of different categories. Market leaders compound over time. And once you've broken out to, somewhere around 5, 10, 15 billion in market cap, to go from 0 to that point is infinitely more difficult than it is to compound from 15 to 50 to 100, right? So I think you look at Nubank, you look at Chime, you look at some of these that are now scaled, and I think it's given the enormity of the TAM and given how big some of the incumbents are, I think that it's not a stretch of the imagination to see some of them, whether the valuation makes sense or not, it's not a stretch to see them, 4x or 8x from where they are today, given the sort of slope of the line to this point. So I do think we will, see at least a few that'll reach that market cap, and it'll probably happen, within the next 3 to 5 years.
So maybe I'll just I actually want to hear your perspective, both of you guys, Alan and Vivek, who see a lot of different opportunities than I look at, or that Max looks at also here in Israel. Really, how do you think about sort of the vertical bank versus generalist neobank approach? Are you seeing a lot of upstart challenger banks, or are most new banking companies really pitching sort of the audience focus right now?
Yeah, I do think that there's a little bit of both. I think the ones that are more interesting, to your point, do have some kind of, demographic focus, right? I think a lot of, it's very hard to be sort of the 50th challenger bank that's kind of just going after everyone, right? I think having some focus, whether it's a vertical focus, and by vertical, you could look at it as like an industry focus, or you could look at it as a segment, right? I do think that that's probably the right way, because at this point, the biggest question on all of these originally was what is their customer acquisition cost? Do the unit economics work? Do you have to raise a lot of money to make them work? And I think if you have some kind of unique angle where your acquisition is lower, or somehow you have some sort of distribution advantage, right? You think back to Green Dot with the Walmart thing, right? Like if you have something like that then ties to some demographic, I think that's probably the best way to go. But could we see someone do something that's like a Chime part 2, or yeah, sure. I mean, again, the market is big enough. I just think it's, when you're the 9th or 10th or 11th player, it's a much more difficult proposition.
Yeah, I would actually say it's interesting, right? I think, like Alan, I think I agree with you, but weirdly somehow like a little bit less this year, because the existing bank value proposition sucks more than it ever has because of the interest rates. So I think maybe like a head-on Chime challenger, or it's weird to even say there would be a Chime challenger, but like a non-vertical bank probably could get more traction this year than they would any other year, because bank interest rates are low, and credit card rewards are meaningless this year. So like maybe this year on balance with others, it's a little bit easier to start. But I like broadly agree. I think where we've seen kind of vertical banks succeed is when they actually it's actually less about the product being verticalized and more about the distribution being verticalized. And I think I actually don't know how many we've seen that have actually cracked like a channel as much as they found ways to get embedded in some type of kind of either vertical SaaS or partnership model. So again, it's interesting, right? Those end up becoming a lot less compelling from a pure technology standpoint. But it becomes like a cash arbitrage where you can kind of get to scale really, really quickly. And then ideally those types of customers are more valuable, so you can upsell lending and a few others. But yeah, probably seeing more of those on balance than kind of straight up challengers.
Cool. So, just in terms of the financial services business model, a significant part of it is obviously driven by fees. And when we look at technology, it seems like in the long run, a lot of these fees should be commoditized, by competition and just building better, plumbing and distribution and ways for consumers to access financial services. Take Robinhood, for example, although, maybe there's other flaws there, but, is there a risk that we're overestimating the total addressable market for fintech in the long run, because ultimately we're going to wipe out a significant portion of what actually creates the market in the first place?
It's a good question. Yeah, look, I think when you're in a sort of like a disruptive industry like financial services, I think there is some amount of cannibalization of what I would call bad fees, right? Look at overdraft, for example, right? I think a lot of the new entrants are saying, hey, we want to get rid of that. And we want to, because that's very punitive to the consumer, and it's sort of bad behavior by the bank. So it's a very good thing for consumers. It's a very good thing for the industry for some of these fees, or some of these I would call more punitive fees, to kind of slide to zero. But at the same time, you're seeing a birth of, I won't call it new fees, but of new sources of revenue, right? So we can take the tipping model, for example, which didn't exist 5 years ago. And now it seems a lot of consumer fintechs are using that, and driving significant revenue from it. So it's a little bit of like, hey, with the disappearance of some of the bad stuff, you can all of a sudden see a world where there's some new models that have kind of been born. And then I would also say, like, the broader point, which we've been talking about this whole time, which is that the pie is growing. Demographics that weren't served before, are now being served. And even if you're maybe not extracting as much economic value per customer, you're still extracting some as a new entrant and a provider, and on an aggregate basis, because we're talking about, like, literally every single person on the planet, right, needs financial services, like that sort of scale. So, I think that, while you do see some of this stuff contracting, you do see the pie growing, and you see new business models developing. And I think that will just sort of happen over time, right, as fintech becomes more ubiquitous.
Yeah, I couldn't agree more with that point. I think, where we see the pie growing is both kind of underserved demographics, but also, I think of, like, you could run a small business on Instagram today, and that counts as a small business, right? There's all sorts of kind of dimensions by which you can cut that makes the number of customers not like 2 or 3 times bigger, but 4 or 5 times bigger. And I think that's one of the justifications you can give for kind of the crazy valuations that you're seeing on certain businesses. Because I do think if you look at, like, kind of the Shopify's and Squares of the world, I think they've proven that they can touch customers that pre-IPO nobody thought they can touch. So I think that probably, I do agree. I think a lot of the fees going away will decrease kind of traditional. It'll hurt incumbents because they can no longer charge those fees. But I do think there's more money to be made overall.
Yeah. I mean, I think just in terms of fees, if we're talking about fees that the consumer feels, then I agree. I think we're heading towards a path towards zero fees for the end consumer at the end of the day. But I think that aside from the tipping model that Alan referred to, which is growing a lot now, interchange is like the tried and true business model fees wise for these fintech companies. And the consumer doesn't really feel that. In theory, they do because it's baked into the transaction, but they don't really feel that. And as long as credit cards are around, which Max Levchin and a couple other people are doing their best to give alternatives to that. But as long as credit cards are around, even debit cards are being used at large, I think that interchange will always be a fee that's going to be lucrative for fintechs to use as a revenue source. And again, I don't think that hurts the consumer as much as overdraft, ATM fees, like we saw with Chime, the report that came out, that maybe they weren't as forthcoming as they should have been with their user base. So yeah, it'll be tough for new upstarts that don't have $50 million in the bank to compete with more entrenched players. But I think at the end of the day, it's better for the consumers.
Cool. Something, Alan, you mentioned earlier was sort of like the resurgence of lending. And Vivek, you and I have talked a lot about this in the past. And, you did some work in the public markets on Lending Club. And, that was kind of a wild ride, but ultimately was kind of boom and bust for a lot of those exciting companies. What current hot trend would you say is going to suffer the same fate? Like, what is everyone excited about that you're shorting in the long run, if anything?
So I think one of the things that I still get kind of anxious about, we'll leave it at that, is probably actually a little bit more kind of like, we'll call it insurance than pure financial services. I think that like the full stack players in that category specifically, keep me a little bit up at night, mostly because I think only a small portion of them do anything kind of fundamentally different. When I think about, like, if we take lending as an allegory and we look at kind of Affirm and Afterpay, you know, while they're not the most elegant technical solutions, they're actually brilliant financial service products that really make the consumer experience amazing, right? Certainly in the United States, the problem is smoothing of cash flows, and nobody's really perfected that. And these guys have, or they're on their way to perfecting that. And I think that, you know, that warrants a certain level of kind of market premium. When I think about the insurance use case and I look at full stack solutions, for the most part, I see great customer experiences that are predominantly powered by kind of slick front ends and kind of, you know, more slightly, let's say, careless onboarding and underwriting experiences. And that comes back to bite you in a pretty bad way. And I look at the difference between kind of like, you know, trading multiples between a Lemonade or a Root and a Progressive. And I think that there's a huge amount of ground to cover. And I'm not entirely sure. Again, we're in a kind of confusing market, so I don't believe shorting works for anyone anymore, or it certainly wouldn't work for me. But I think if there was one category where I said, unless one of these next generation carriers was really intelligent with acquiring, using their kind of like arbitrage and revenue multiple to acquire a bunch of other carriers, bolster their revenue, improve their margins, think really critically about customer acquisition, I think a couple missed quarters of revenue could lead to a pretty significant like stock price tumble. But as Max knows firsthand, I've been wrong about this, I think every year since 2015. So please, I wouldn't hold your breath for me to be right.
Mm-hmm. Yeah, I'll focus maybe on a specific company as opposed to a specific trend. And I don't think they'll mind that I'm calling them out, but I think that Stripe is probably overvalued. And I actually wouldn't be long Stripe if I had the opportunity to be. Not because I think the Collison brothers aren't great. They're obviously brilliant. Not that I've met them, but just from hearing them on podcasts, I'm pretty sure they're great guys and they built an amazing company for sure. I just think that what they're trying to do now, trying to build out products in pretty much every other area of fintech that we're seeing with Treasury, with Stripe Checkout, etc. I'm not sure if they're best in class yet at doing this, and I think that startups are coming to eat their lunch. Startups that they're investing in as well, by the way, which we saw with their investment in Fast recently and Rapid here in Israel. And so I'm not sure that this sort of idea of creating this fintech behemoth or payments behemoth and eating up every sort of area that has some type of relation to the payments ecosystem is going to work in the long term, but that's being baked into their valuation and their long-term view. I would much rather bet on, again, specialized startups that are going to build out best-in-class products for each specific vertical that Stripe is trying to go after. So I would say that's probably my like very anti-consensus view of something that's considered hot in fintech right now.
Fascinating. So I don't really, unfortunately, I don't have like a category that I'm down on. I guess I'm sort of the eternal optimist within fintech, which is maybe I'm drinking my own Kool-Aid a bit too much. But look, one area that, and we haven't talked about yet, so I'll just take us there. Is crypto, right? It's not, and it's not that I'm.
There, but yeah.
Okay, well maybe I'll save my.
No. Please go. We can jump right in. Everyone in the audience has been like, "When are we going to talk?" No. Go for it.
Yeah, so it's not that it's not that I'm down on the category and or have a particularly negative view. It's just as I think about, I started in venture, I think somewhere at the same time as Vivek in sort of like that 2016, 2017 era, and saw the whole build up right in 2017, and then the quote unquote crash in 2018, and then kind of nothing happened right for a few years there. And so now you sort of see it again. It's a little bit of deja vu, right? It's and you kind of ask yourself what is different this time, and you can kind of point to a few things about institutions and people like Elon Musk and others, taking it more seriously this time, or maybe seriously, right? I don't know. Mm-hmm. It's hard to tell with him, but I just have more questions than answers really about the whole thing. I think I still, as I saw before, the store of value and sort of that use case, but it's unclear, at least to me, why this time things are different. But I'd love to be educated. So if either of you have a perspective, I'm all ears.
Yeah, I mean, I think the Fed is, pumping every market. And, it's just when there's much more supply of money, all asset prices go up. At the same time, there's, let's say, a new trend of decentralized finance experimentation that may or may not already be solving some of the financial infrastructure issues that the legacy systems and the existing financial systems face. And I will say that the user experience of sending value through crypto is actually pretty good, assuming that you're on an exchange and have, a wallet. So I think there are some functions that are happening. I don't know if you read on non-fungible tokens, the not boring write-up or the generalist write-up. I don't remember, Yonatan, you do, but pretty compelling case for why, digital scarcity around a digital piece of art, is an interesting use case for kind of the public to transact around collectibles that are, natively digital. At the same time, it feels like VCs have such a powerful incentive to promote crypto, given that they were the early adopters, that it's hard to distinguish, who's, really bullish and who just has such a strong financial incentives to put this on the loudspeaker and blow up the Ponzi scheme to the ultimate highest point, that, they're kind of just billionaires without doing anything. My strategy has kind of been to be somewhat exposed, but not fully exposed throughout this whole run up, just because I'm traumatized by 2017, 2018, and maybe to my, misfortune, but that's just kind of been my approach. But, there's this thing about money. It's belief at the end of the day. Like, you need to believe in the government that, basically backs the currency in today's financial system. And we've seen that has actually collapsed currencies in the past when the government defaults or when the government is no longer, reliable. The currency appreciates to the Zimbabwe degree, and then the whole economy kind of collapses and needs to be bailed out by the World Bank or the International Monetary Fund. There could be a case to be made that the amount of money that the U.S. is creating right now to basically fend off collapse and complete social chaos, will have some negative impact on its clout in the future, and maybe that's what's driving the Bitcoin surge in addition to all this liquidity. And then my view on the other world of DeFi we can get into, but it seems like a lot of the Bitcoin attention just kind of naturally bleeds into the rest of the ecosystem, regardless of how well any of these other projects are doing. And when you have a $600 billion market cap and a $300 million market cap, it doesn't take much to move the needle on that, project that really has no proof. And the same kind of thing happened in 2017, 2018. Everyone was piling into Bitcoin. All of these other things just started to go haywire. And then as soon as people, turned psychologically on Bitcoin, the whole thing kind of collapsed and people lost 90% of their shirt. The last thing I'll say before kind of opening it up is that there seem to be a ton of margin products in this market because it's unregulated. And so I think the volatility that, can come on the downside is significant. I would also say that we're seeing that in the public markets as well. And I don't want to get into a public market macro discussion because we'll get far away from the future of fintech, but there's definitely some funky things happening that may not have a positive ending, given what history has taught us. So.
I think those are also, they're all awesome points, Max. I would say, I'll start with an annoying and oversimplified analogy, but only because it's top of mind. Right before the pandemic, I decided I was going to splurge on one of those awesome wireless chargers for my iPhone, where you just kind of like put it on and you're charging. And it was actually one that was portable. And then the pandemic happened, and my iPhone's been at like 100% battery since. And I've like never had a reason to use it because it's always plugged in. And I had this like cool portable charger I spent like $75 on, and I will like literally take it to the living room just to use because I like want to get to like squeeze some juice out of it. I think that's what I've always felt like the commercial applications of crypto is, like a really fat, or like even we'll kind of bundle blockchain into it too, which actually I think has more commercial use cases, like really fascinating, like technically sound. Like it feels intellectually there should be some like critical application. Like we've all heard the use cases in like title and in like digital identity that like I'm certainly not technical enough to understand how it would work, but like my naive brain says that like it should, and I really want it to, and I kind of go into most pitches with optimism, and it hasn't yet. Not to say that it won't, but I think so far it's been like a kind of a, you know, a solution, like seeking a problem, if you will. That being said, one of the places that I have heard, and again, this is not a space I spend a lot of time in, so kind of focus on more, please correct me. But like one of the places I've been pointing to by people who do spend time in the space has been like the stablecoin run up, and how there's been certain use cases. And for example, you know, if Airbnb wants to pay out someone in like sub-Saharan Africa who doesn't experience, you know, in, you know, whatever country, it costs them like $19 to remit the payment to them, because it has to go from like remittance to remittance to remittance. You know, there are certain instances where a stable coin that does like an instant conversion payout could be really interesting. So I think that we're probably in the super early days of finding kind of use cases for those things. I don't believe that's the reason why the prices are running up. I think it's for the same reason the prices are running up elsewhere, between stimulus and unemployment checks in the United States, and the same reason like Robinhood is going bonkers. I think more people have a couple $100 to throw around, and certainly in some of those, like, you know, the Dogecoin kind of like earlier products, like a couple $100 goes a long way across kind of 1 million people. So I suspect that's where the numbers are going up. But I do think that there's been some like in the craziness, there's actually been a couple pretty interesting use cases that are catching on, but they're early, certainly on the commercial side.
Yeah, I don't have much to add here, so I won't go for so long. I think that it's funny that Max is definitely my crypto guy whenever I have a question about the space. And it seems that both Alan, Vivek, and also myself are all a little bit skeptical about it. So interesting that you put together a panel on Future of Fintech and chose 3 people that don't really feel as bullish as you do about the space, Max. And also not sure what that really says about either about us as investors that spend a lot of time looking at fintech, or about the crypto space as a whole, that people that spend a lot of time there don't necessarily feel so strongly about it. But again, I'm definitely not the right person to ask in terms of real deep understanding of what's going on in sort of the DeFi world. So I'll leave it at that from my perspective.
Hopefully that gave you some education, or maybe diseducation. So yeah, we're kind of wrapping up. Maybe time for you know, one or two more questions. I got a question from the audience that said, what's the craziest idea you heard and think might just work in fintech in the next few years? And I think that's a good kind of place to wrap things up.
I heard a pitch a few weeks ago of a vertical bank focused on ex-convicts, and it was founded by an ex-convict himself. It was actually one of the Wolf of Wall Street partners at that firm, who spent about 10 years in blue collar prison, and then in white collar prison, sorry, and then got out of jail, and he experienced, you know, firsthand himself. All the banks turned him away in terms of opening up a checking and savings account. He wasn't able to. Most, you know, I would say like lucrative credit cards turned him down. Wasn't able to get loans, and it wasn't that he necessarily wasn't good for it. He just has the stain on his record of being a convict, and so he's trying to build a new bank focused on, you know, providing these financial services to individuals who, in theory, aren't less trustworthy, but the system just doesn't have a way to associate risk with these individuals. I mean, he's a crazy dude, so wasn't interested in investing, but it was a crazy enough idea that I do think that maybe there's room for it in the marketplace.
Cool.
I'm going to take the easy way out on this maybe, and just say, you know, we're investors in Rapid, And when I first heard that pitch, I didn't think it was possible. I mean, you're talking about last mile payment collections across, dozens of different geographies and in very, I would call emerging markets, incredibly hard problem to solve. And, there's a lot of bigger players that like Stripe we talked about earlier that could do what they're doing or could eventually do what they're doing. And I just, been totally awed and amazed by the progress they've made. And they've definitely made a believer out of me. So.
Yeah, and their advertising is
awesome.
all over Tel Aviv right now. So thanks for giving me
Spamming us.
Maybe it's sign of the times with all the money they've raised.
Exactly. Vivek, what about you?
I would say there's one, I don't even remember the name anymore, but it was just like, it's a concept that stuck with me, and certainly during the pandemic has kind of come back around. But it was like a reverse ATM, where basically you would be able to, instead of having to go pick up kind of your cash from banks, let's say you wanted to deposit a check in return for some cash, you'd be able to effectively like text your bank branch, and they would send a representative to your home, to a predetermined location, which that last part sounded a little sketchy. You can imagine kind of going to a park and like sitting on a bench waiting for like a DoorDash driver to hand you a wad of cash. But it's one of those things, again, like I'm sure there's something that needs to be perfected about it, but like there is a genuine question about the validity of bank branches, and like the need for folks, particularly now during the pandemic, if you're older and you're getting, your checks in the mail from your employer, like you probably don't want to do that or don't want to go wait in an ATM line. And it's something that went from like a ludicrous pitch to like, and there's a crazy stat, right? There's like a larger number of people like under 30 opened a bank account in person than their parents did in like 2019. Weird, because like in the United States, at least, like a weird financial illiteracy problem, right? You like don't trust the internet, so you're going to go make sure your account is real in person. And I like there's some weird macro trends around it that I think it might just work. Probably not with our money, but someone else's, maybe it might just work.
Okay, fine. Final question, because you just made me think about bank branches. So bank branches, are they Borders or GameStop?
And neither were very successful until Reddit decided to make GameStop successful, right?
Agree. Nothing more to add.
Okay. I'd say that like I think it depends on the geography, right? Like actually, like bank branches abroad, certainly in Southeast Asia and stuff, are an impediment, right? There's a ton of digital first branches that have been able to expand without needing kind of branches, and where they do exist, they're truly just kind of hubs for cash disbursement. I think in the United States, for certain banks, I think it's gonna be really interesting, right? You have like a lot of banks, like the Huntingtons of the world, that have like built their presence because of their bank branches. And I think we'll end up seeing some really creative use cases, right? Imagine like a commercial bank branch, which is like a WeWork effectively, right? Like finding ways to repurpose that real estate to benefit your end consumer, being able to let folks do video calls from there and stuff like that.
Yeah.
So I don't think, per usual, I don't think it goes to zero, but it's hard not to see how, particularly for folks who that was their main thrust, how that has to change. And I think the hard part is going to be finding ways to digitize that experience and bring that kind of like friendly, caring, kind of one-on-one interaction online. But I don't suspect we're going to see one on every corner for quite some time.
Okay, Yonatan, Alan, Vivek, this has been awesome. Thank you guys so much for the time, the insight. I'm going to do a little write-up after the fact and, summarize some of the insights and the thoughts that were shared. And yeah, hope you guys have a great rest of the week. And look forward to talking again soon. Thank you to all of the attendees as well for making the time.
Thanks, man.
Thanks so much.
Bye.
Bye-bye.
Talk to you later.